Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. The key patterns here were, for many months now, have been the late March to late June diamond pattern type with the extension of its lower uptrend highlighted in bright green on my daily charts in the upper left corner, and the larger, also in upper left corner, big inverted roof pattern, sometimes called a half diamond, which is highlighted in purple on my daily chart. Prices originally managed to reach the primary topside target of the first diamond pattern type, but failed to make it to the harder to reach secondary target. Then in early August, the market punched down through the purple uptrend of the inverted roof pattern and has headed lower ever since. So where does that leave us now? I said when the move lower started, and I quote, a primary target X2 for the inverted roof stroke half diamond pattern will be down in the 733 zone, with a secondary harder to reach target X3 down in the 646. This is only the first few days of this move lower, so it could still be a false break, but those are the potentials for such a pattern as this inverted roof pattern. End of quote. Move lower reached the primary target in the 733 zone in late August, then continuing down at the end of September through some very interesting supports that are now resistances, specifically the big 50% absolute Fibonacci line at 697 and the 50% Fibonacci line of the 2011, the big 2011-2019 move at 691. Then in October, prices mainly saw hesitation and even some small recovery over the 50% Fibonacci line at 691. But in the last week or so of October, the market pushed lower, and on the last day of October, the market reached target X3, the hardest reach target. Now, 2 weeks ago, I highlighted one new feature I saw here, looking at the action since August. I was looking at a possible descending, expanding wedge pattern, currently 605 to 695, which is highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but it does hold merit, and I would look to this pattern for some immediate idea of the move downwards. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in recent times with respect to what was going on and what the opportunities might be. This is no longer necessarily the case, but it still has its moments. In late February, and especially at the start of April, so that is just within my daily chart at the moment, the market constructed a large bear channel that morphed into what we see highlighted in dark blue on my daily chart. A descending, expanding wedge pattern, currently 613 to 811. This originated from December late last year, but it really became evident from February this year. The upper trend line has been escorted and reinforced, sort of, by the declining medium moving average, currently at 802, which combined together to help cap the market back in very early April, then mid-April, mid-May and mid to late June. However, in mid-July, the attempts higher resulted in a clear break above the upper trend line and also the important declining long moving average, currently 829. Prices climbed rapidly up to the 50% Fibonacci line of the significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that's captured my attention, as the market has, since late July till mid-September, formed a descending scallop pattern. Not only that, but since mid-September we have seen the market form the crucial ski bump of the descending scallop pattern, and since the start of October start on its journey lower to potential targets for such a pattern. Thus, the primary target X for such a pattern would be in the 708 zone, with a secondary hard to reach target X1 in the 689 zone. In early to mid-October, the market made a valiant attempt to turn back up, but the May low at 769 capped the rise and turned prices back down into a band of supports, starting at the August 2017 high at 754, then at 744, then the important June 2021 low at 737, that is the gateway to a band of congestion between 737 and 724. All these were tested, but they held, though the subsequent rise late last week and this week has only managed a lower high at the August 2017 high. and have seemingly started to head lower again. Should prices drop below this 737, 724 band, well then the next congestion is at target X at 708, and it would then highlight a newer pattern, one that I spotted 3 weeks ago. And that is the nascent late August to date bear channel, highlighted in bright red on my daily chart. That's currently 693 to 776. It is interesting to note how we have a smaller bear pattern within a larger bear pattern. One final thing I would note is the descending short medium moving average, currently at 760. This might start to act as a shepherd to driving prices lower, so watch out. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.